Hello, and welcome to our market alert video for today, which is February 2nd, 2024. January is already over. Oh my gosh, does time fly when you're having fun? And I hope you're having fun. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America, and our singular goal is to create as many squippers as we possibly can. Of course, as you know, squippers is the acronym for second childhood without parental supervision. When a client of ours retires, we call them a squipper. And we want them to go out there and start squippering their little tails off. Anyway, let's talk about this week. Very, very busy. Lots of very important news when it comes to what's going on in the economy. Let's start with the Federal Reserve Chairman, Jerome Powell, came out on Wednesday and basically said what we've been saying he was going to say all along. In fact, we've been saying for months that the people who thought that the Fed was going to lower interest rates in last year were wrong, and the people who thought now that they're going to lower interest rates in March were wrong. We still stand by our fearless forecast, which is that July is when the Fed might start lowering interest rates. However, Jerome Powell, the Federal Reserve Chairman, came out and said, yes, inflation's coming down, and yes, the economy seems to be okay, and yes, all those things are happening, but we are not going to lower interest rates until we see the whites of 2% inflation's eyes. And the question is, how long do they need to see the whites of the eyes? Because what they don't want to do, and Jerome Powell has said this repeatedly, is we don't want to repeat the mistakes that Paul Volcker made back in the 80s. He was the Federal Reserve Chairman back in the 80s. And what he did was he declared victory too soon over inflation, started lowering interest rates too soon. Inflation picked back up again, and now he had to raise interest rates, and that havoc ensued after that, and that was not a good thing. So they don't want to do that this time around. They want to learn from the mistakes of the past. So that news was not well received on the day of. As you guys may have noticed, the stock market and the bond market both went way down on that news. Since then, stocks have recovered some, and the bond market continues to kind of be wrestling with the thought. Our view is that this year, because the economy seems to be holding, we got numbers on Friday, which told us this morning that said that jobs were amazing. They came in at almost double what people thought they would be. So the economy seems to be holding despite the high interest rates, and that bodes well for companies' profits. And that, of course, in our view, drives stock prices. So we continue. Our fearless forecast is that stocks will do well this year as inflation comes down, as the cost of money comes down, as the consumer has more purchasing power with lower interest rates and lower inflation. All those things should help profits. On the bond side, we did say that this year we think bonds are going to do very, very well. Why? Because as the Fed lowers interest rates, bond values will tend to go up. And since we're coming off the worst bear market in bonds maybe ever, then the rebound in bonds could be the biggest maybe ever. Now, will it be a straight line? No, of course not. And in fact, bonds took it on the chin when Jerome Powell said what he did. But we told you that would be the case. It's not going to be a straight up line. It's going to be a bumpy ride on the way there, which is fine, as long as we end up higher, which we think we will be once the Fed does start lowering interest rates. So overall, our fearless forecast seems to be coming true just as we thought it would so far, but we're only 1 month in, so we'll see. But we believe that that's our what we call our base case scenario. Now, what could go wrong, and what should you worry about? Okay, if you want something to worry about, here it is: the commercial real estate market, $1 trillion. So many of those deals were predicated on very low interest rates. They were built on practically 0% interest rates. The Fed has raised interest rates to over 5%. Many of those deals now are facing 8% interest rates. And so when they're refinanced, some of those deals, or many of those deals, could be not profitable anymore. And those companies may say, you know what, we're going to walk away. They could declare bankruptcy. The banks could be held holding the bag. And in fact, there's a big bank in New York that probably made a mistake, it looks like. They bought a regional bank. They took on a lot of those commercial real estate loans, and now they're finding their profits severely impaired. And there's a lot of talk that this bank could be downgraded. Shades of 2008, when banks were holding all that bad debt. And you know what happened to the stock market in 2008, right? So our view is that we hope for the best, but we plan for the worst. Growth is important, but protection of principal is even more important. That's our basic philosophy when it comes to managing our clients' money. So If the real estate market, the commercial real estate, $1 trillion market, does fall on its face, and there are a lot of credible analysts in many of the bigger banks that are saying it's likely. If that happens, we could have a significant drop in the stock market. Are you prepared for that? Our invest and protect strategy told us to sell in November of 2007, before the big crash that happened in 2008 in the real estate market. So our strategy is still in place. We're ready to use it again should the eventuality happen. Do you have such a plan? I believe that once you get within 5 years of retirement, or you're within the first 5 years of your retirement, it is very, very important for you to have a strategy to protect your principal. It's going to provide you your income during your retirement. It's your security. You don't want to put that at risk, we think, and you need to have a plan to mitigate that downside so you can live to fight another day. That's what we think, and it's our philosophy. If that resonates with you, visit with us. We'd love to help you with that. Okay, so our website is rpoa.com. Thank you for watching this video. If you do go to our website, please download our podcast, okay? Last year, we had over 250,000 downloads. Our goal this year is 1 million, and we can't do it without your help. So download the show. I think you'll find it more fun than a human being should be allowed to have. You'll learn about your finances at the same time. So thank you for watching this video. Share it with your friends and family, and I'll look forward to talking to you soon.